Good morning, everyone, and welcome to another edition of the Horizon Investment Conversations that we've had throughout the year, which is 2020. Thank you all for being here again. I appreciate your time. I appreciate the time you've given us throughout the year, and certainly everyone that's with us today. And I'll introduce them right after I get done reading the very important disclosures that we have. So this webinar was created in October of 2020. It's provided by Horizon Investments, LLC for educational use only. The opinions expressed herein are as of the date of the report and are subject to change without notice. Forward-looking statements cannot be guaranteed. This material should not be considered financial advice or an offer to sell any product. Horizon reserves the right to modify its current investment strategies and techniques based on changing market dynamics or client needs. There is no guarantee that their assessments of investments will be accurate. The discussion, outlooks, and viewpoints featured are not intended to be investment advice and do not take into account specific client investment objectives. Before investing, an investor should consider his or her investment goals and the risk comfort levels and consult with his or her investment advisor and tax professional. Information has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. Past performance is no guarantee of future results. Risk assist is not a guarantee, that's all in capital letters, against loss or declines in the value of your portfolio. It's an investment strategy that supplements or a more traditional strategy by periodically investing assets in a portfolio of fixed income securities based on Horizon Investments' view of market conditions. Furthermore, when risk assist is deployed, whether partially or entirely, to mitigate risk for an account, the account will not be fully invested in its original strategy. And accordingly, during periods of strong market growth, the account may underperform accounts that do not have the risk assist feature. While risk assist was designed with the goal of limiting drawdown, Horizon is not able to predict all market conditions and ensure that risk assist will always limit drawdown as designed. Accounts with risk assist are not fully protected against all loss. So with that, let me introduce the team that we have with us today. You will recall Austin Fitch. He is a CFA, Chartered Financial Analyst, the highest educational designation available in the financial field. Austin is an analyst at Horizon Investments, has been so since 2012. Also joining us, Josh Bartholomew. He is head of practice management at Horizon Investments. As I've mentioned before, Josh and I have had the pleasure of knowing each other. I should say the pleasure most of the time knowing each other for about 18 years now. So very glad always to have Josh as part of the conversation. And really, in all seriousness, Josh as part of Tranquilli Financial Advisors team of experts that I get to reach out to on your behalf as clients and have a great conversation with. In the background, I'll say, doing that work for you, and I enjoy doing it. And we also have Jackie Walsh with us. She is the Tranquilli Financial Advisor communications intern presently. We have her located, I believe, in Wisconsin, she said today, last time joining us from Chicago. So we're really glad to have Jackie back with us. She will be finishing out her internship towards the end of the year here. So I would like to strongly suggest that a communications person and graduate like Jackie should meet all of you, and we should all be working hard to get one of these fine young people working during this challenging time for sure. So Jackie, that's my pitch for you, and I'm going to keep going, all right, because you've earned it for sure. So with that, let me start off with aligning, I should say, second part of it. I'm just going to read for a moment. Here's what we have to cover today, so we're going to get to it. Politics, bonds, stocks, oil, free isn't free, and Bitcoin, because no one can get enough of Bitcoin. So let's start there. Let's start with the politics. We've led off all year with this subject, and I think it's a good idea to do it right now. Austin, please, if you would, because we do want to get to so many topics, how about if I ask you to just jump in, give us the, if you will, lay of the land politically and overlay it onto the investment world right now.
Yeah, Lou, and thanks again for having us. I think we're really excited to be here. I would tell you the political side of things in 2020 has just been another headline item to go with the pandemic, and it seems like everything else that has been thrown at us this year. But I think we're finally starting to get past that, and you're seeing that from a market standpoint really over the last maybe week or two. And what I mean by that is markets are really starting to kind of come to grips with, what the new normal is going to look like from a political landscape. I think I would tell you, if we had entered at the beginning of this year, maybe the markets would have priced things a little bit differently in terms of expectations. Given how things played out during the year with the pandemic and some of the social unrest, obviously, I think that probably had an impact on the outcome of the election in regards to even just, who the candidates were for that matter. But I think what you've seen is, and I think we actually saw it officially yesterday, is you're starting to see that transition of power. And really what that boils down to is it does look like there's going to be a Democrat in the White House. So Joe Biden will, all signs point towards a Joe Biden presidency starting in 2021. But the flip side of that is the Republicans appear to have maintained control of the Senate. Obviously, we're still waiting on the runoffs in Georgia that will take place the first week of January. So there are two runoffs, Senate seats in Georgia. Right now, the Republicans have 50 seats. They just need one of those two to really maintain that majority control in the Senate. I think the last number that we saw internally was that there's a 95% probability that the Republicans would win at least one of those two seats. So you have to at least start to, again, markets are starting to kind of price that in. You have to believe that that's probably how things are going to play out. The one thing that I think probably didn't get as much coverage in, I guess, 2 weeks ago or 2 or 3 weeks ago when we had the election was the House. And I think the reason I say that is because coming into this election, there was really the widely held belief that Democrats were probably going to pick up anywhere between 15 and 20 seats in the House, which would have basically given them almost a supermajority in the House of Representatives. What you actually saw on election night was that the Republicans actually picked up 6 or 8 seats. Okay, so why is that important? Well, this goes back to probably many folks' high school civics classes, just in terms of how legislation gets going and really gets done. Kind of the sausage making process, if you will. Bills have to start in the House of Representatives. Then they go to the Senate, then they go to the White House. Okay, so why is that important? Well, if we think back to election night, if you had a supermajority of Democrats in the House, if you had Democratic control of the Senate, and then you had a Democratic president, I think the fear from a market perspective, and again, we're solely talking about markets, is that maybe you would start to get more of that far left agenda that was initially talked about. If you think about Bernie Sanders, if you think about Elizabeth Warren, in regards to taxes, in regards to regulation, in regards to many different things that from a market perspective would have been a little bit more prohibitive. What we now have is a majority for the Democrats in the House, but a much smaller majority. So the idea of getting many of those far left bills even started is a much lower probability. Right. Then you have the Republican control of the House or of the Senate. Why is that important? Well, even if you get something that's maybe a little bit outside of the realm of normalcy from a kind of a Main Street regulation or Main Street legislation, you would have to believe that the Republicans and the Democrats are going to come at it from two different sides. It's probably not going to make it to the White House. So that's where I think we would view kind of the current outlook from a political standpoint, kind of what we would call divided government. And I would tell you generally from a historical perspective, markets are actually very positive on divided government. And the reason being is because typically when you have divided government, what that really boils down to is that kind of government stays out of the way of markets, of business to an extent. So again, generally it's a positive. It's maybe not as far of a positive if you would think maybe a Republican presidency would have been a little bit more continuing the deregulation train that we've been on for the last 4 years. But again, it's nowhere near a negative, and I think you've seen that from a market perspective in terms of the reaction since the election. One, you have more clarity, but two, you also have this idea that with a divided government, that they're kind of going to be, I won't say hands off, but they're going to kind of stay a little bit further back because of the opposing views that really they have to meet in the middle somewhere for anything really to get done.
Austin, just so we're setting expectations, which I know Lou wants to do you expect a lot of volatility around this runoff, this Senate runoff, I think in Georgia, or there's a high probability, you said, of the Republicans keeping the Senate, but do you expect a lot of volatility end of the year, beginning of January?
No, I don't think you should expect to see a ton of volatility. I think maybe the one, spike in volatility would be that if you did get both Democratic candidates winning those runoffs, maybe you get a little bit more volatility in terms of then you have Democratic control of all three branches or all three sides of the equation. But again, I don't think it's a spike in volatility unless something like that happens.
Well, and Austin, I will clarify because again, Jackie did a great job of sending out the message. When you say far left, or even if we reference far right, we're only discussing this for everyone on the call live and those that listen to it later. We are only discussing this as it applies to investing client money, which I have said for, I've been at this almost 30 years. I care about politics as it applies to my clients and those people that we all care for. So that's exactly what we're talking about. How does it apply to stocks, bonds? So I would like to stick on the stock market for a moment and ask you about this. The last time we spoke, we were looking at a market where roughly 5 stocks in the S&P 500 were really driving the value of that index upward, which is incredible volatility that we can't overstate how much risk is associated, where you think you're buying 500 stocks, but really 40% of what you're buying is concentrated in 5 securities. How is that looking now? Has that, I'll say, dispersed throughout the S&P 500 a little more throughout the markets overall at this point?
Yeah, you've absolutely started to see a rotation just to a more broader market, if you will, over the last 2-3 weeks. Some of that has to do with the election, the fact that you have seen, a little, like I said, a little bit more certainty in regards to what the outlook looks like in 2021 and going forward from a political side of things. But the other piece, and this is probably the bigger piece driving that rotation away from those mega cap tech stock names, is the vaccine, which I know we'll talk about, and the news around the vaccine and obviously the effects on COVID-19 and the pandemic that obviously we're all currently in. That's been the bigger kind of driving force behind that rotation. But maybe to your question, your Apple, Microsoft, Google, Facebook, those companies, which, like you said, led the way for the first 10 months of the year over and above really everything else in the marketplace. Not that they've, been decidedly negative necessarily over the last couple of weeks, but what you've seen is everything else in the marketplace has been much more positive. So from a marginal outperformance standpoint, whether it's smaller cap companies, whether it's companies outside of that tech space, you've started to see that rotation away from those mega cap tech names that really led the marketplace, like I said, over the first kind of 10 or so months of the year.
Okay. And so if I can just tie it together again, we can't uncouple, if you will, or decouple, I'm sorry, decouple the politics from the stocks from now pandemic conversation or vaccine conversation. So we were speaking briefly before we got started here, talking about the number of firms or pharmaceuticals that are out there working on this right now. Is all of the good news already priced into the stock market? Because I will reference back to our previous conversations. That's why those watching right now, we've had a really great reaction from clients overall that have watched this either live or come back and watched it later on. they're hearing us talk, I'll say, carrying on the conversation. So I do want to reference back to those previous conversations. We had so much, we had discussed a lot of the pandemic and how it was an impact, how it was, go back to the beginning, a true unknown to the markets, to what does it look like, the future of the markets, the economy, the micro economy, the macro economy. So let me get to the question. Right now, 6 or 8 different firms are working on the vaccine at the same time. Is that already priced in your opinion, to where the level of the market is right now? Or once the vaccine is being distributed, does it push stocks even higher, in your opinion?
Yeah, no, I think that's absolutely fair. And I would say this, if you'd asked me this question maybe 3 weeks ago, I would have said absolutely not. You're asking the question today, I would tell you it's different. I don't know that it's fully priced in, but it's a lot more priced in today than it was 3 weeks ago. And the reason I say that is obviously it's been 3 consecutive kind of Monday mornings now when you've had news come out about, vaccines that honestly will probably be available, now not mass availability, but will be available in some capacity probably before the end of the year, which does, again, and I mentioned this idea of uncertainty, and I think it's important to touch on that, because markets don't deal well with uncertainty, and that can be politically, or that can be from a vaccine perspective in regards to the uncertainty around when does the economy open back up. And what you're starting to see as you get this news around these vaccines is you're starting to get more certainty from a timeline perspective. Okay, so if vaccines are available by the end of the year, what does that mean in terms of, how long does it take to get mass inoculation, right? Is that something that is complete by March? Is that complete by April? I would have told you 3 weeks ago, we would have kind of been spitballing to say, when is everybody at least going to have access to a vaccine? I'm not saying that we have that answer today, but I'm saying we have a lot more information today than we had 3 weeks ago, because now the availability of even, like you said, there are 8 firms working on it. The availability dates of 3 of them. And you also know a little bit more in regards to the production of those 3 specifically. Again, it's not set in stone. We can't say by April 30th of next year that we'll have 300 million vaccines available. We're not there yet. But again, a lot more today than you knew 3 or 4 weeks ago.
Austin, wouldn't you say though that too the markets are pricing in pretty conservatively distribution, in the sense that it's going to take some time to get these things out into the market, and certainly there'll be population groups that are going to have access to it prior to others?
Oh, absolutely. No, and we've talked internally a couple different things. So Josh, I think you bring up a great point. What we're looking at is probably that first round, becomes available to, your first responders, your healthcare workers, and then folks that are extremely vulnerable, either from an age or a pre-existing condition standpoint. The benefit, and Lou, you mentioned the idea that 8 firms are working kind of at the same problem. I would tell everybody on the call, so we have somebody on our investment management team who's been in the industry since the 1980s. He actually started in the industry as a healthcare analyst. What he has said time and time again this year is never before in his career has he seen 8 firms, and not just small firms. These are big, well-known names. So you've heard the names Pfizer, you've heard the names AstraZeneca, you've heard the name GlaxoSmithKline, Johnson & Johnson, all Fortune 500, pharmaceutical companies. All of these companies are working at the same problem. And he said that's never before happened. And why that's important is to the point of, the 3 companies maybe that have vaccines today, there's absolutely going to be a supply side problem. They're not going to be able to generate enough of the vaccine to get mass distribution in the next, by Easter or by the middle of next year. But if you have 5 more companies from a vaccine standpoint, in terms of that manufacturing, again, that just starts to make the problem easier in terms of getting that available to everybody within the U.S. Again, I'm not going to go out and say that, you know, by the middle of next year, everybody's been vaccinated. I know, and we could have a whole separate discussion about, you know, the willingness to get vaccinated. I think that, like I said, that's a separate discussion. But in terms of availability, the fact that we have so many companies working on it and you're starting to see those timelines become much more clearly defined, I think is why you've seen markets pop over the last, call it 2 weeks. But I do think that there's continued room to run as you get more around, you know, just the number of companies generating vaccines, but then also more clarity around that timeline.
All right, and the timeline, and I just want to clarify a few things because I never want to speak financial advisor, so just to step back for a moment and say priced into the market. So vaccine priced into the market, a recovering economy, the jobs numbers priced into the market means the current level of, I'll call them the usual suspects of indexes, the Dow, the S&P 500. I've mentioned before that my personal favorite happens to be the Russell 2000. Josh and I talked back at the beginning of the year about both watching the VIX, which is the volatility index. That happens to be very, very low right now. Not at its lowest point, but down significantly. So when we're talking about pricing it in, that just means what is the overall value level of the market. So, and I want to throw it over to Josh on the bonds here in a moment, but just to wrap up, I want to make sure I offer Jackie the opportunity if she has any questions on any of the pharmaceuticals or any, because we certainly want to give her the floor as well, and she's on mute. So we'll ask her to take herself off that, and if she has one, she can let us know. But the stock market itself, and let me be the financial advisor for a second, rather than the host. When I hear that it's priced into the market, and we all, I think, have a clear understanding, this is not going to get distributed quickly. That's not going to. I hate to sound like the negative person, but we're years away from this being distributed to everyone, we'll say, because there have been 11.5 million cases in the United States. If I rely on the expert, Anthony Fauci, that I heard say it, he said everyone needs to expect to get this. Well, that puts us 320 million people short of everyone getting it. That's going to take some time. So being realistic about it, I still hear cautious growth, if you will, from the standpoint of, yes, we should, I'll say, feel good about it, of course, but there still has to be an element of unknown or caution as it applies to all of this as well. Is that a fair comment?
Yeah, Lou, I think that's absolutely fair. And I think what you'll see probably as we get into 2021, and I know this can be a divisive issue as well. I don't know that masks are going away in 2021. I don't know that social distancing necessarily is going to be, fully gone in 2021. Like you said, that just because there's a vaccine doesn't mean that we can all snap our fingers and get the vaccine. There is absolutely going to be a period of time when we are working through getting people inoculated, and then also phasing out some of the restrictions or regulations, if you will, that we've all come to know over the last, call it 8 months. So I think you're absolutely right. You mentioned it earlier. We're looking at probably a couple years in reality of phasing the inoculation in and phasing the regulation out. As you do that, as more people get inoculated or as more people get the vaccine, there is less of a need for social distancing. There's less of a need for mask wearing. There's maybe less of a need for individuals to quarantine that are maybe high-risk individuals. So I think you will start to see stuff, you're working in two different directions there. So I think that's important to understand. But I think what you would see as we get into 21 is you start to see more clarity. And that's where when we talk about being priced into the market, and to your point, if we're looking at specific areas of the marketplace or specific indices, there's a possibility of things being viewed in a more positive light as things get more certain, as we get more understanding around, okay, where do we stand from a vaccine perspective in terms of what percentage of the population has a vaccine? Where do we stand in terms of mask mandates starting to go away? Where do we stand from a social distancing standpoint? When can we put 80,000 people back in a football stadium? I don't know that it's 2021, but you're starting to move in that direction. And as you do that, markets will view that clarity positively.
And any progress is positive, Austin. But I just, in the vein of Lou's earlier point about kind of going back to some of the things we've talked about in calls past, one thing that's missed is we do have progress towards the vaccine. Won't get distributed immediately to everyone. We'll have progress. If we can avoid shutdowns, obviously that's a huge bonus to the economy. But we also have an economy that's been flushed with stimulus that I think gets lost in this conversation. I want to go back to that because we've talked about it in previous calls. I mean, there is a ton of stimulus been pumped into this economy. We haven't seen the full effects of it.
Oh, not at all. And honestly, I would tell everybody on the call, we're probably looking at another stimulus package coming, if not before the end of the year, then early in 2021. And I think what we've talked about internally is if you think about the fact that there's so much money, Josh, to your point, that's being pushed into the system, and then you have a solution to the problem in a sense. Again, it may not be solved necessarily, but the solution is in progress. All of a sudden, you have kind of a tailwind, two different tailwinds that are both pushing the economy and the marketplace forward. One being the fact that you no longer, you have less of a concern around the pandemic, but at the same time, the fact that markets and really business generally is going to be more flush with cash in 21 than they were in 2019 is another positive that, again, I think, and we can talk about this separately as well, we may pay for down the road, right? Because there's no, Lou, you mentioned that there's no free lunch. So I think what we're talking about here is in the short term, that stimulus money could absolutely be a benefit over and above the fact that the pandemic maybe goes away.
Well, and that'll lead to the bond discussion that I know Josh wants to have, and I want to turn it over to him and ask the questions on that because our mutual friend Greg Vallier just sent something out talking about bonds and the headwinds and the challenges they face moving forward. So Josh, I know you've got a few questions on it. I think Jack, you might have a question about debt as it applies to the future as well. So Josh, why don't you lead us off, and then we'll.
I will. We still have to find a way to unmute Jackie if we can, possibly, because she's still on mute. But Austin, to that end, the reality of it is we set up 2021 potentially coming out of a year that feels terrible. It's going to end up, from an equity market standpoint, I think, okay. Mm-hmm. Certainly where we're headed at this point. And to your point about divided government aids that sort of effect throughout the end of the year. But I think the real headwinds are in fixed income. And I know Lou has lots of clients with that are moderate, sort of balanced type of approaches. There are headwinds within the fixed income. And we're at interest rates that are going to, very low interest rates, and that environment is not going to change for, I'd say, 3 years or
easily.
More.
Yeah, I would say 3 years is probably on the conservative side from a interest rate perspective. Good news is if you feel like you've missed the boat on refinancing maybe some debt or a mortgage, you have plenty of time. But Josh, to your point around fixed income investing, we're looking at probably 3, 4, 5 years of interest rates probably remaining at historic lows. And that can be, again, for retirees or for folks that are maybe more moderate or balanced. From a portfolio standpoint, that can absolutely be a game changer. And why I say that is because if you think about maybe what a more moderate or balanced portfolio has gotten you historically, so think about a blend between stocks and bonds, you've had a stock component, which obviously adds some level of volatility to the overall portfolio, but then kind of the bond component has served as that ballast, right? It's dampened the overall volatility, but it's also added anywhere from 4 to, in some cases, 8% of a return of just that segment of the portfolio. I think, unfortunately, what you're seeing is that fixed income returns are going to be and expected to be so low over the next few years, is that while the bond component maybe still dampens some of that volatility, it doesn't offer you the return capabilities that it has historically. And just having a conversation, maybe I guess it was over the weekend with my parents, and they grew up at a time when, and I'm sure there are many people that can relate to this, their first mortgage was 13, 14%, right? They grew up at a time when you put at least part of your portfolio into bonds, regardless of what age you were, because bonds generated 8, 9, 10%, right? It was a no-brainer. Unfortunately, we now live in an environment where that bond component of the portfolio is nowhere near 8, 9, 10%. I mean, luckily, we're no longer paying 13 or 14% on a mortgage, but you can no longer rely on that bond component for that sizable return within a portfolio. So I think the question then becomes, okay, so what do I do? What does a portfolio look like if I would still consider myself a more balanced or moderate investor? Do I have to go out and do I have to take more equity risk in order to get maybe the expected return that I would otherwise want to get? And I would say that's one way to do it. That's probably not the way that necessarily we would think about it from a financial planning standpoint. Obviously, the volatility associated with taking on that much more risk for many folks is just uncomfortable. So I think this is, and Lou, I know you and I, we've talked about this a number of times, is you have some form of risk mitigation that you can put over top of equity markets. And Lou, I know you use a couple different strategies, one of ours being the risk assist strategy that you mentioned earlier, but the idea that you can mitigate some of the volatility, but be still exposed to an equity market where maybe you can get a higher level of return from a historical standpoint, and you're no longer as reliant on that fixed income component or that bond component for a portion of your return. So I think that's something that from a financial planning standpoint, you're probably going to start to see is maybe, I won't say turning away from bonds entirely, but probably reducing bonds marginally and trading it out for a version of kind of equity exposure that does have some form of downside risk protection or risk mitigation over top of it. That way you don't, you're not exposed to the volatility that you would normally be exposed to in pure equity markets, but it does give you a little bit more upside potential compared to a bond that's paying, 0, 1, 2%.
I think just it begs the question, Lou, and I think it's important for people. This is the thing we've been talking about quite a bit with our advisors, that for clients, planning is so important. It's why, Lou, we work with you, and not, to do a plug for what you do. The reality of it is it's important to have a conversation. If I'm super conservative and I've got a lot of fixed income, I should at least have a conversation about maybe looking at how that portfolio is constructed and changes that we might make. Because I do think that there are headwinds, and it's important to do the planning now, given what we know. This is something, Austin, like you said, it's not going to change in the next 3 to 5 years. Can you touch a little bit on government debt? I mean, just talk about where we stand there.
Yeah. No, and we get that question a lot in terms of, you see in the news the idea that the Fed's balance sheet is as high as it's ever been. And like I said, we talk about this idea that, government debt today is, much higher than it was, for that matter, even a year ago now. What I would say about that is it's probably a much longer term problem. It's probably going to affect the younger generations much more than it's going to affect the folks that are nearing retirement today. It's probably, realistically, it's probably a 20 or 30 year problem for the country, and not a 5 or 10 year problem. So I think that's something that, unfortunately, my children are going to have to deal with as they get into their working lives, as opposed to probably anybody listening on this call. Now, that's not to say that that's good or bad, because that obviously is affecting future generations of everybody here. But I will say that there has been talk and there has been fear of the amount of debt that we have is going to suppress future growth. And I would tell you just where we sit from a country standpoint, and where I would say probably the biggest competitor in terms of driving global growth, China, sits, we're still at least one, if not two generations away from that debt becoming kind of such an issue that would change that leadership.
Speaking of younger generations, we have unmuted Jackie, and
she is.
And so I know she has a question. I can see it in her face. So why don't we let her ask one?
Good morning. Hi, I'm sorry I was on mute before. My question was kind of just what you were talking about, just like what the timeline of that debt is going to play a role in like my future financial decisions as I graduate college and enter the job market, if it's going to be something that will be evident within the next couple of years, or it seemed like what you were saying, it's more so going to be the next 2 or 3 generations. So just kind of that was.
Yeah, and Jackie, I think that's a great question, especially, like you said, as you're getting ready to enter the job market. What I would tell you is, and the reason that it is maybe a longer term problem is because today, if you think about who the biggest buyer of U.S. debt is, it is China. So the question is always posed, well, what if China decides that we're no longer going to buy U.S. debt? What does that become an issue? Well, it would, but what I would tell you is the rate at which they're growing, they can't afford not to buy U.S. debt to fund their growth right now. And that honestly, and this is why it becomes a 20 or 30 year problem, that isn't going to change over the next 10, 20, maybe even 30 years. Now, the real question is, and this is where you have to look at the interest rate discussion, and it's part of the reason that I would say we at Horizon believe that rates maybe can't go and won't go higher for the foreseeable future. You also have the conversation about paying down that debt or the cost of servicing that debt. That's part of the reason that rates will not go higher. Couple that with the fact that rates globally are actually lower than they are in the U.S. And again, I think that contributes to the fact that rates will be as low as they are today for quite some time. But again, the bigger picture being kind of that debt overhang, it really isn't an issue because the pace at which China's growing, they need that capital, and really the only place to get it in terms of a reliable source, if you will, or a reputable source would be the U.S. So I think that that continues to play out, which again gives the U.S. time to try and clean up the balance sheet. I will say this: if you look back to 2008, 2009, similar conversations were had then. If you fast forward 5 or 6 years, the U.S. had actually started to do a pretty good job of starting to deleverage that balance sheet. Now, that happened, then you started to get some volatility 2018, 2019, and then 2020. So you saw that slow down and actually come to a grinding halt as we started this year. But they do have a track record. I would say that the U.S. government, the Fed specifically, has a track record for taking money off the balance sheet, which I'm not going to say that they're going to be able to get it right again necessarily, but they were getting it right from a market perspective in terms of starting to take money out of the system without having a catastrophic impact, over the last 3, 4, 5 years. So the question really becomes, maybe 5 years from now, are they able to do the same thing? We would all, I'm sure, hope and believe that, because if that's the case, then the debt overhang that we're worried about 20 years from now may not be there 20 years from now. So I think that's the other thing to keep in mind is it's a much longer term problem, but it also gives us time to solve the problem in a sense because there is so much time on our side.
And Austin, I'm going to jump in there and wrap the bond discussion up with this because we have a couple of topics to get to. For everyone here with us watching live, we're going to extend the time that we're together, if that's okay. And for everyone listening after the fact, keep listening because it's all very interesting. But I want to throw this in on top of the debt because I don't want to be Pollyanna about it, but I do want Jackie to hear some good news about it. So I sat in on a UC Berkeley conference call where they talked about the debt servicing in the United States, why our interest rates are higher than the rest of the world when they could actually be lower because we can effectively afford the whole thing, but we're keeping ours higher because we want that infusion, if you will, that we want that borrowing that's coming from China or other solvent countries, the EU. So we're actually encouraging them to come to us because don't forget, bonds mean we are lending, we're being lent money, we're paying interest on that at the interest rates that are so low right now for the US. For our debt servicing, we're busy refinancing. We're sending out new debt at much lower numbers than have been over the course of the last decade. So there's if you will, a gaming of the bonds that we are from an economic standpoint working through right now. We're actually lowering our debt carrying expense while also taking on more debt. And their number was as high as $30 trillion of US debt could be out there because we can afford the interest payments that are on it. So we could then grow the economy, which if you look at the US, and this is digging in pretty deep, but if you look at the US population numbers, because of the last 20 to 25 years of newer Americans, which that's their term, not mine. I thought it was a great way to put it. The population's gone up, or is going. The population numbers in the U.S. are going to increase, not decrease. Huge advantage from an economic standpoint and the ability to pay down that debt and grow the economy. So all those things, they're in a lab somewhere. I would love to know what tunnel they're in because I'd love to listen in, be a fly on the wall for that. But I thought that was a really, really interesting discussion and some good news that you don't necessarily hear when it's reported about debt overall. All right, so oil. Give us just a couple of minutes on oil. Will it ever come back? Is it over for oil?
I won't say, let me say this, energy, it's not over for energy. Oil as we know it or knew it, it may look very different. And the reason I say that is, and I think it would have been regardless of which party occupies the White House. It may happen slightly faster because Biden's in the White House. But I do think clean energy, green energy, however you want to term it, is becoming kind of the energy sector, or will become the energy sector of the future. That's not to say that oil completely goes away. But if you think about what used to be the energy sector 10, 15 years ago, it was all the big oil names, oil refineries, oil distributors, oil, you name it, up and down the supply chain. Energy stocks had some tie to oil as a commodity. Again, what I would say is the energy sector will not go away. It will just be maybe more diversified to where oil is a component, natural gas is still a component. But you start to have much more in the way of more of that clean energy that we're talking about. And again, this would have happened regardless of which party won this most recent election. It's just kind of the way that things are going globally. You can see it in Europe specifically in terms of the carbon credits and what's being, what's happening there. I think what you're seeing today is the reduction of oil dependency specifically playing out from a stock market perspective. So if you look at what makes up the energy sector, Those companies that are so oil dependent or oil heavy are smaller players today than they were 10 or 15 years ago. And again, I don't think they're going to become, I don't think they're going back to being the size that they were 10 or 15 years ago. Not to say that they're completely going away, but I do think new participants in that energy space are going to create a more diversified kind of energy sector going forward, as opposed to predominantly just being, if you think about energy, you think about oil. I don't think that's going to be the future of that sector.
Got it. So it used to be oil and then everything else. Everything else was almost a sidebar, or even, I'll dare say, laughed at it, that somebody, wind energy, everything else.
Right.
But things change, and we have to be, well, how's it go? We have to be on the wave of change, or we get crushed by the wave of change. So I'd rather be on it than getting crushed. Just a couple quick, and we said there were a few of them. Free isn't free. We talked about the Michael Kitces article about trading costs. I think this is, I apologize, but this is a bit of me on my soapbox right now for the next couple of topics, which is, I love Don't Get Mad, Get E-Trade. I work with E-Trade Advisor Services. When everyone that's on this call listening to it, share this with friends and family. When you hear free as it applies to investing, I'm going to say that's not accurate. Okay, that's all there's. It's somebody's getting paid somewhere, because it has this Tranquilli financial advisor, from a micro standpoint, couldn't turn on the lights, have this conference call, pay for the computers and everything that goes along with running a business and having people spread throughout the country working with it for free. It's a bad business model, okay? And I would ask everyone that when you hear that you're not being charged for trades or anything like that, it may be accurate from a very technical standpoint, because E-Trade Advisor Services are no transaction fee portfolios. Everyone on the phone loves that, but there's something there, and certainly Schwab and all of the others. I'll call out all the names if I need to. Robinhood, a dangerous app in my opinion. Okay, I'm not asking Horizon to comment on that. I'm just saying Robinhood, very dangerous.
We won't comment on it. Yeah, we're not going to comment.
You're not going to comment. Okay, Robinhood, awful. So anyway, Bitcoin. I want to wrap it up with Bitcoin, because I had a few calls this week, and one I really loved was the comment was, this Bitcoin doesn't seem to be going away. And no, it's not going away. But I sat on a conference call Monday, it was, with the SEC. They 4.5 hours of different topics. And for those of you who want to watch it, you can actually go to the sec.gov website and watch the replay. I find it actually very good. I think the SEC does a great job of talking about these things. Bitcoin is presently unregulated, correct? It is traded on what is known as the dark web. So red flag number 2, okay? It has no backing from any government. It is purely an exchange of some kind of value between two people, or two, you don't even know if they're people, things on the dark web of the internet. It's probably not a good investment right now. And I want to just share one, and this I do want comments on. The SEC, and why I bring up watching that conference call, what was so interesting about it, they said they are starting to look at how to regulate it, where there would be an organized exchange of Bitcoin, and how it could have some kind of actual backing, not just internet backing, or not kind of, how it could have some kind of backing from, if it's the US government, whomever it might be. So I find that very interesting. I don't think we're a decade away from it being something that we would look at. I think we're probably 2 decades away from that. And someday it could be like Star Wars, where we're trading on government credits, kind of thing, for fuel and everything. But with that said, would you comment on Bitcoin for me? Because getting the question, and it just, how's this? My job, I think part of it is I'm the gatekeeper. I stop the jump in with both feet to the dark web, that's just doesn't sound like a place that we should all be hanging out, in my opinion.
Yeah, Lou, I mean, I think I would say this on multiple fronts around Bitcoin and your comments. You're absolutely right. And I would start by saying kind of what you said at the beginning. No, it is not going away. But I think you're absolutely right that it is going to take time before it becomes kind of a normal form of currency. And I say that for a couple reasons, and you hit on a lot of them. The fact that it's completely unregulated right now, just from a government perspective, just think about the ability to, in this case, not tax transactions, right? They're not going to be okay with that. We all know that. So there has to be some form of regulation, which is a little bit ironic because the whole reason that cryptocurrency even started was to kind of eliminate, interaction or regulation with central banks and governments. But I do think for it to be used in mass, which again, I think someday it will be. Maybe this is something else again that my children are dealing with 30 plus years from now. But I do think
that too, just to be clear. But
what's that?
I said I'm still going to be here to deal with it too. But keep going.
No, but I think it is something. I think it is something that we continue to move that direction. But there has to be a lot more clarity around kind of the regulation. I mean, right now, to your point, the only way to buy this cryptocurrency, and Bitcoin is one example, but there's many other types out there. You have to go through, like you said, what's called the dark web. Just the name in and of itself should let everybody know that it's maybe not necessarily above board. Not that it's illegal.
Like a dark alley.
Yeah, not that it's illegal, but there are things that can happen on the dark web that I think, Lou, you and I were talking. If somebody steals your Bitcoin, sorry.
That's right.
Right. Yeah. You don't have any form of recourse, which I would say if you think about kind of a normal form of currency, you would like that. I mean, the idea of FDIC protection, obviously is something that we all kind of know and love, just within the banking system that we operate in today. So I think that's something that will have to continue to develop. But again, at the end of the day, it's not going away. It's only going to continue to become more and more mainstream. But I think, Lou, you kind of hit the nail on the head when that doesn't necessarily mean that it's a good investment today either. Because if you think about something that's unregulated, that is the definition of volatility in my mind, right? And you've seen it. If anybody's watched the price of a Bitcoin or any cryptocurrency, there are days when it can be up 70, 80, 90%. There are days when it can be down 60, 70, 80%, right? It is the wildest swings. If you thought March from a volatility standpoint was bad in the stock market, it's that on steroids on a daily basis. And it can happen kind of overnight from a cryptocurrency standpoint. And again, the idea of it being unregulated means at the end of the day, you can be left holding an empty bag, and unfortunately not have any form of recourse. So I think that's where we would sit today, knowing that as we go forward, it's going to become more mainstream. It's going to become, there is going to be, the government is going to figure out whether it's the US government or just governments globally, central banks globally, they absolutely are going to figure out a way to use cryptocurrency as a currency of the future.
All right.
We're not there yet, but it's coming.
So, Austin, if you put your portfolio management hat on real quick, just quick answer. There's no edge. There's no way for you to invest and sort of have a fundamental reason why you would invest, and that's kind of the key thing here, right?
Yep, 100%.
And one more on that, just to wrap it up for now, I'll say, because we're all going to look at this as time passes and consider it as it becomes more of a, we'll say, regulated. And that's where I want to wrap it up on Bitcoin is regulated. So pure speculation on my part. If you can go out there, not illegally, and buy something of what you're considering value right now on the dark web, Bitcoin, once the IRS steps in, the US government steps in, wherever it is that supports the value of it, are they going to support that current version of cryptocurrency, or are they going to say, well, that was nice that you did all that. It's kind of like playing fantasy football. You didn't really win a game. You just traded some fake value. But now that we're stepping in, all your value is gone, and ours is the real value. I mean, that, nobody wants to buy what is it? Federal dollar, not federal dollar. What were the Confederacy?
Confederate bonds.
Confederate bonds.
Yeah, you're not buying Confederate bonds, right?
That's exactly right. Nobody's buying Confederate bonds right now. So it could, the winner will take over valuing it. So with that, I have just 3 quick things. There will be another conference call next week. We have with Beacon Capital Management. Chris Cook and Vanguard will join us. So please, that'll be next Tuesday. Jackie, remind that you could just shake your head. That's at noon Eastern time. Next, thank you. We can't get through a call without a conversation about either Austin's beard, my hair, Josh's beard. If you get a good look, you can see the curls. I would tell you that I'm staying away from open flames, which I may have mentioned before, because there is so much product in this hair that I would go up like a tiki torch. But I will say, if you're 80, my hair would have looked just like this. And if you get what I'm saying, it would look just like this.
By the way, that's saying something, since just yesterday was your 54th birthday. That's saying something.
Thanks, man. I appreciate that.
I'd sing to you, but we don't have time.
And of course, Thanksgiving is my favorite holiday. So I hope everyone has a very, very nice Thanksgiving. It has been an interesting year, to say the least. As my dad says, they're all interesting. Some are more interesting than others. You can apply that either way you want here. But I will finish by thanking Austin for all of his time, his input. It's so appreciated. I want to thank Jackie for her excellent work during her time here at Tranquilli Financial Advisor. The work that she is doing, that our interns have done over the years. It's been a really great part of my building this business, if you will, and sharing that with all of you, because I do have interns and I like hiring them. And Jackie's been excellent during her time here, and I appreciate her. And of course, Josh, thank you for arranging the calls. Thank you for making sure that I have access to the team at Horizon at a moment's notice. It's genuinely appreciated, and so is your support. So with that, everyone, thank you so much. We'll see you next week with Beacon Capital Management. Have a great holiday, and thank you all for taking the time to be here with us.
Happy Thanksgiving.
Thanks, guys.